The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome to this episode of the FedLife podcast. If you are new, allow me to introduce myself. My name is Dan Sipe. I'm actually the founder of Serving Those Who Serve, and I'm also your host. And additionally, I'm the branch manager here at Lee Sipe & Associates and Serving Those Who Serve. I want to begin, as I always do, by saying thank you. Thank you for taking time to watch or listen today. And above all, thank you for your service to the government, to the country, to me, to everyone. You don't hear that enough in normal times. These are not normal times, so you're definitely not hearing that enough now. But you're always going to hear it here. The other thing you're always going to hear with us here is Ed Zerndorfer, the guru. He's back with us once again as part of our ongoing mission to reach, teach, and serve you, the career civilian Fed. Once again, we will follow and amplify Ed's FedZone articles to give us one more way to reach and teach. So, Ed, today we're talking about a change that the OBBA made to the ability to deduct state and local taxes. Now, here again, folks, you'll want to grab Ed's FedZone article because there are some great charts and examples in there. So, Ed, this story starts all the way back in 2017 with the Tax Cuts and Jobs Act. So, tell us what happened then.
Well, Dan, as you know, it's tax season right now, and all my columns in the FedZone are going to be concentrating on tax season. And one of the major changes that came out of OBBA, in case no one knows what that stands for, it's the One Big Beautiful Bill Act of 2025. Last July, Congress passed a tax law signed into law by President Trump, and there's some major changes in it. Now, one change was the deduction of state and local taxes. Now, the reason I'm going back, I mentioned about the Tax Cut. You mentioned about the Tax Cuts and Jobs Act of 2017. That the Tax Cuts and Jobs Act of 2017 was a major piece of legislation. And among the things that came out in that law, this was during President Trump's first term, was the fact that Congress decided to make the make itemizing one's taxes not that as attractive as taking the standard deductions. So they limited a number of the itemized deductions, one of which was state and local taxes. And let me back up before and talk about what happened before the Tax Cuts and Jobs Act of 2017. Before the Tax Cuts and Jobs Act of 2017, an individual who itemized, that is, filed Schedule A, they could deduct with no dollar limitations, state and local income taxes.
Sure.
State and local property taxes, real estate taxes for a first home, for a second home, personal property taxes. And if they happen to live in a state that had no state income tax, there are I think there are about 7 such states, they could deduct their state and local sales taxes. Again, with no dollar limitation in terms of how much they could do in taxes. Well, come the Tax Cuts and Jobs Act of 2017, Congress decided they're going to limit the amount of state and local taxes that you could deduct on one's taxes to a flat $10,000. Now,
it's not a lot.
As my old geometry teacher used to say, looking at a problem, let's take 3 steps back and think about this. Let's think about all those people who live in states. I don't want to get political here, but I'm going to mention blue states. States like New York, California, New Jersey, Minnesota, okay? To give an example, our older son lives in New York, West Hempstead, New York. Their property taxes down are $16,000 a year. New York has a pretty high income tax, 10%. He and his wife work. I will tell you, when this law took effect, he told me come February 1st of any year, he already paid the $10,000. For the rest of the year, none of the taxes they paid were deductible. So here comes the One Big Beautiful Bill Act. And one of the changes was that Congress decided that they're going to put a limit of $40,000. Oh, by the way, the $10,000, by the way, I want to back up one moment. The $10,000 limit applies to single tax filers, married filing jointly, head of household, married filing separately, $5,000. Everybody had the same limit except married filing separately.
Sure.
The One Big Beautiful Bill Act of 2025, the limit was put at $40,000. That's a little bit better, especially if you live in a high tax state. And of course, that applies to single, it applies to head of household, married filing jointly, married filing separately, $20,000, 20,000 limits. And it applies to, again, the taxes I mentioned, state and local income taxes. If one does not lives in a state that has no state income tax, they can deduct state and local sales taxes, personal property taxes, real estate taxes. I'm about 1 month into the tax season now. I filed a bunch of tax returns, and I noticed that a lot of my clients who have high incomes, they were shocked to find out they're getting refunds. They're paying much less in taxes because they live in these high income states, and they didn't realize that they are not limited to $10,000. They were so puzzled. I'm getting a refund back? Boy, I was expecting a whole bunch.
Sure.
The Tax Cuts and Jobs Act of 2025, this particular provision, limiting it to the limits of the $40,000 in state and local taxes and other property taxes, things like that, is good only for the years 2025 through 2029.
Gotcha.
Because come 2030, we're going to go back to $10,000 limit. And I have to add one other thing here. As all good things when it comes to the tax code, if your income is over a certain amount, you may not get the full benefit. You may not get any benefit of this $40,000. In particular, what Congress said, and I'm reading it here from the code, said that if your adjusted gross income, that's not taxable, an AGI, is over $500,000, the $40,000 is starting to phase out. To the point that if your AGI reaches $600,000, your state and local tax, other local tax limitations goes back to $10,000. It's a gradual phase out. So that is the good news in terms of this year and for the next couple of years. I think that it also invites for a lot of planning. We can talk about that in a few moments in terms of what we do.
Yeah, and folks, again, be sure if you're listening to this, grab Ed's column out of the Fed Zone because Ed, he always gives us great charts and visuals and also some great examples. And so let's talk about those examples a little bit, Ed, because you gave us three that really help paint the picture. So let's talk about your first example, Howard and Elizabeth.
Yeah, Dan, I love examples because that's the way I learn. That's the way I learn. I learn by examples. So you'll see them all over in the Fed Zone. All right, I have three examples to help everyone understand. Example number one, we have a married couple, Howard and Elizabeth. They live in New York, high tax state. Okay. They pay $24,500 in state and local income taxes. They both work. So between the two of them, they had deducted or they paid estimated taxes, a total of in state and local taxes, $24,500. Their property taxes were $15,500. Okay. For the year 2025, Howard and Elizabeth itemized deductions on Schedule A, and it turns out that their 2025, it's really modified adjusted gross income. It's one adjusted gross income, add back a few items. It's all discussed in the article, but for most people, it's going to be their adjusted gross income. It turned out that Howard and Elizabeth adjusted gross income was $398,500. They're below the $4,000. So what does that mean? It means that Howard and Elizabeth can deduct the entire $40,500. $24,500 plus $15,500 makes a total of $40,000. They're going to be very happy when they get their taxes done. Okay? So that's example number one.
Absolutely. Now, tell us about Vincent, an example two.
Okay. Example number two, Vincent. During 2024, Vincent paid a total of $30,000 in state and local taxes, and he paid $15,700 in property taxes. Now, he's single. His 2025 adjusted gross income is $317,500. It says that although Vincent's adjusted gross income is less than $500,000, the $317,500. Remember, we said his AGI was $317,000. How much can he deduct in state and local income taxes? It's called the SALT deduction, by the way. SALT, the state and local tax deduction. Well, if you add $30,000 to $15,700, you come up with $45,700. Vincent is limited to $40,000. So what happens to the other $5,700? Sorry, no benefit. That's what his limit is. Okay?
Got it. So that wasn't great news for Vincent, but now let's take a look at Francine, who's over the $500 or $500,000 amount. What happens for her?
Okay, so now Francine, we have Francine. She paid a total of $26,000 in state and local income taxes during 2025. And $7,000 in property taxes. That's a total of $33,000. Okay. During 2025, her adjusted gross income in 2025 was $530,000. She's over the $500,000 threshold. I have a table that shows for every $10,000 above $500,000 up to $600,000, how it phases out. It turns out with $530,000 of AGI, she's $30,000 of the cap. She's going to lose $9,000. 3% of $30,000 over the cap, 3%. That's how the phase out goes. 30% rather over the cap. So 30% of $30,000 is $9,000. So her maximum 2025 SALT deduction is the $40,000 maximum minus $9,000, which is $31,000. So she's going to lose about $2,000. She had paid $33,000, but she's limited to $31,000. So
not quite as bad as Vincent, who lost $5,000, but still, losing about $3,000. We're still a little bit better off than we were, but thank you for making that clear. And again, folks, those tables are great. So you don't have in front of you, you definitely want to loop back there. Now, Ed has a tax practice, so taxes are near and dear to his heart, and he's always spot on with them. So the other thing that's great about the articles that he does is he'll give you examples of the forms themselves. So Ed, you've got a pretty good visual of the Form 1040A, and you walk people through what's going on what line. So why don't you take us through that?
Yes, so that's part of the Fed Zone column. And I have a portion of Schedule A, in particular, lines 5 through 7. I took a camera shot and put it onto the column. So, in particular, in terms of where you put the various taxes you pay, I have a list. State and local income taxes. State and local income taxes are potentially deductible on Schedule A in the year paid. I put the words "in the year paid" in italics. And the reason I did that, I get this question all the time. Ed, I think I'm going to be able to itemize. I'm going to be able to itemize my deductions, itemize this year because I paid a lot in state and local income taxes. In fact, I paid estimated taxes for the year 2025. I made all 4 installments: in April, in June, in September. And the last installment was due January 15th, 2026. That was for 2025. can I include all 4 payments? And I said, I got some bad news. I got some bad news. Here's the bad news. That because we are what's called a cash basis, that payment you made in January 2026, this was the 4th estimated tax payment for 2025, is not going to be able to be included. That's the bad news for 2025. Now comes the good news. It will be included on your 2026 tax return. And I got some even better news for you. You know that payment, that balance due you paid last year for on your 2024 state and local taxes? Yeah. Boy, I was shocked. I owed the state $3,200. Oh, this was disgusting. I'd have paid the state $230. I said, well, calm down. I got some good news. When did you make that payment? Yeah, you told me to make it by April 15th, 2025, and I did. Fine. Now comes the good news. You can include that $3,200 payment that you paid for the balance due in your state and local taxes. So that's running by cash basis. So online 5A, it says state and local taxes or general sales taxes. I'll get to that here in a moment in terms of which one you do. You can't do both, by the way. I don't know if I made that clear. You have a choice of deducting the higher of your state and local taxes that you pay during the year or your state and local sales taxes you pay for the year, okay? And if you elect to do the general sales taxes, you have to check a box. There's a little box there by line 5A that you're going to deduct state and local sales taxes. It's a little tricky how you figure out how do you do sales taxes. I always joke to my clients, well, don't you keep all your receipts all the time for all the stuff you buy?
I was just thinking that, man. It's like, that's a lot of receipts.
Well, the IRS has come to our rescue. They have a table what the average person pays in each state in sales taxes. They got a table. You can go right to the table. And you can add to that the sales tax you pay on big ticket items like cars, boats, things like that, So it could be added to that table. Okay. So
gotcha.
Your favorite local accountant will be able to help you with that in case. Okay. Then on line 5B, state and local real estate taxes. I want to point out that a real estate tax is deductible in the year it is both paid and imposed or assessed.
Okay.
To better understand this, let me give you an example. I live in Montgomery County, Maryland. I think, Dan, you also. Dan, you notice you get a bill from the county property office. Each usually comes in July because the Montgomery County is the state of Maryland is on a fiscal year basis. So the fiscal year starts July 1st and ends the following June 30th. And you get a bill. And it says you owe, let's say, $7,000 of property taxes, and you can pay it all in full when you get it, or you make it in installment payments. Okay, so the question is, it straggles two years here, 2 calendar years, from June 1st through December 31st of like this year for 2025, and then January 1st through June 30th, 2026. Can you deduct those taxes in full, even though it's covering another fiscal year? The answer is yes. Yes. So you can include, when you get a tax bill in a particular year, you pay it that year, you can deduct it on your taxes that year as a state and local tax. That goes on line 5B. And then we have state and local personal property taxes. Some states, not all states, have personal properties. I know I have several clients who live in Virginia. Virginia has personal property tax.
A lot of feds live there.
What's that?
A lot of feds live in Virginia.
Yeah, a lot of feds there. So I usually have to pay a personal property tax on your car, some other items. Those taxes are now also includable as part of your state and local taxes. And again, the limit for everything is $40,000 up to $40,000 per year. And then on line 5E is where you have the limit. Okay, it says here, I'm reading it now. Enter the smaller of line 5D or $40,000. 20,000 married filing separately. If Form 1040 or 1040 line 11B, that is your adjusted gross income, is more than $500,000 or $250,000 if married filing separately, or you completed Form 255, that's the farm earned income exclusion, you have to see instructions. And my feeling is that if you're going to do this by hand, don't. I mean, you can do your own taxes, and there's some great programs out there. TurboTax is a good program, and they can handle that. So please, everyone listening, the days of doing your taxes by hand are over.
I couldn't agree with you more, brother.
Okay. Maybe you want to go to a tax professional that they definitely have the software and they can work out all the details, because it's a challenge.
It's a lot.
I always say, Dan, these are laws written by accountants and lawyers for accountants and lawyers.
Very true. Very true. And I don't know how you keep it all straight, but I'm glad you do. And I'm glad you do it here with us. So that's another exceptional article, sir.
Thank you.
So on behalf of all our feds, thank you for being such a great resource. Well, folks, that is a wrap. We are Serving Those Who Serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify. That way you won't miss an episode. And you also help us get the word out, because when you subscribe, the algorithm goes, hey, feds like this, so I'm going to show it to more feds, so we can help a lot more people that way. Please remember to share it with your friends and even a few strangers. Don't forget our live webinars every single week. Just go to the SWS website, swserve.com. You'll see the webinar button. Click it, and the whole menu will come up. Yeah, the guru will come to you. Reach you where you are, teach you where you are, above all, serve you where you are. Sign up for one, sign up for all. Be sure to read Ed every single week in the Fed Zone. We cover a couple of them, but there's always a few extra that are fantastic. And you can find that at swserve.com and also at Fed-Zone. So signing out for Ed, the crew at Serving the Serve, and me, Dan Sipe, I will sign off as I always do by saying good luck, Godspeed. Above all, remember, it's your Fed life. Make it a great one because you deserve it. Stay well, everybody. We are out.